Are you thinking of buying a car just before the end of the year to make it to 2025's tax deduction? Have you heard about all these conflicting advice? That includes EV rebate is gone. The larger electric vehicle tax deduction is gone. Gas cars are way better and gas cars are cheaper these days, and gas are cheaper because the carbon rebate's gone and EV tax benefits are dead. Some of these advices out there are simply wrong and some of them are half true. The CRA tax rules did change over the last few years. And we're going to dive deeper into analyzing the tax benefits of buying an EV versus a regular car. But before I get started, make sure you give us a thumbs up if you like our video and find our video useful, and share that with your friends. And also hit the subscribe button below if you want to stay on top of the latest tax tips. Now with that, let's get started. Well, CRA had made some changes over the last few years regarding the EV tax deductions and rebate system. This includes the EV rebate completely gone at the end of 2024. Also, the big first year write-off is completely gone. And in the past, the motivation to purchase the electric vehicle was because of the skyrocketing gas price. And now because the federal government finally came around and realized that the carbon tax on gas alone is not really helping the environment except adding the tax burden to everyday taxpayer, they've cancel that all together in the budget 2025. So gas price is going to stay the same for a very long time and is not nearly as expensive at its peak when carbon tax was imposed. So then it comes back down to, with all these changes, is it still worth it to purchase an electric vehicle if you're in the market for a car versus buying a gas car? Now we're going to analyze it all from pure tax perspective. Before I get into the nitty-gritty to talk about the differences between the tax deductions and all the calculation, I just want to clarify that the one rule that never changes. No matter what vehicle you choose, EV or regular gas car, or even hybrid, doesn't matter. All these vehicles, you are only eligible to claim the business use percentage of the car expenses. If you use your vehicle 80% of the time for the purpose of running your business, you would be eligible to deduct 80% of the vehicle expenses. And that 80% of the vehicle expenses could include gas or electricity. If you're charging your car, electricity is tax deductible, insurance, maintenance cost, tire change, car registration, and in Ontario, that is also canceled, CAA fees. I have CAA membership fees as well, so that would be also tax deductible, but up to 80%, because in our example, we said that 80% is for business use, tolls, 407 bill, also lease payments if you were to lease a vehicle, or capital cost allowance, which is a depreciation, that a special tax term for depreciation that's allowed by CRA. And there are special rules attached to the capital cost allowance if you own the vehicle. And then there is interest cost that you are allowed to deduct, but subject to a limit. And of course, you can also deduct the direct parking expenses for the purpose of running your business. 100% of that would be tax deductible, provided that each parking cost incurred is for the purpose of running your business. So that rule never changed. If you incur $20,000 of auto vehicle expenses altogether and only 80% of your car use is related to business, therefore $16,000 would be the tax deductible expenses. So that never changed, whether it's EV or gas vehicle. That stay the same. But what you really need to know is when it comes down to buying a vehicle, there are different incentives available. And now that's the reason why we need to talk about something called capital cost allowance and capital cost allowance classes. So when you buy a vehicle, purchase a vehicle, you can finance it or you can pay it all in one shot with cash. You could buy it with line of credit, doesn't matter. You purchase the vehicle. If you purchase the vehicle, you are allowed to deduct that vehicle, but you are not allowed to deduct the vehicle in one shot as a 1-year expense. Instead, CRA makes you deduct it slowly over a period of time following the formula that's provided by them. And this is equivalent to the tax version of depreciation, also known as capital cost allowance or CCA. But here's the part that most people miss. Not every vehicle is treated the same way in the eyes of CRA. So the deduction for different vehicles in the different buckets that's defined by CRA would be treated differently. Sadly, CRA doesn't let you write off the vehicle as quickly as possible as you want, because that would be how we all want to handle our vehicle write-off. But the reality is that every vehicle gets assigned a CCA class, and that class would control how much of the purchase price you are eligible to claim as a vehicle expenses, and you can depreciate against it, and whether there is a maximum amount limit the claim, and the annual depreciation rate. Why this matters? The CRA limit creates winners and losers, and that's when, as you can see, there are 3 different classes in terms of how you allocate your vehicle purchase, and there could be guest car that's under $38,000. In summary, there are 3 different classes that most people need to know when it comes down to purchasing a vehicle for business use purpose. There is class 10, there is class 10.1, and there is class 54, and each of them would have different attributes and different deduction rate and different limit. And in particular, for class 10, we're looking at full cost allowed, and it's only applicable for any vehicle purchase under $38,000. But on the flip side of it, if you sell it for more than the remaining tax cost available, there is something called recapture income that you need to calculate. And then for class 10.1, on the other hand, it is applicable for any passenger vehicles that are purchased with a price tag over $38,000 before tax, and that class specifically would have 0 recapture. So even if you sell it later on for way more than what is the remaining tax balance on this particular asset, you would not need to pay the money back to CRA. That's what that 10.1 class is so special for. And then the last one is the class 54, the traditional EV or any zero emission vehicles that has a way higher limit of $61,000 that's available for deduction. And also there is recapture attached embedded in this particular class. And these limits just do not change based on the trim level, options that you choose, the features that you have, whether you use it in a corporation or sole proprietorship, or whether you use it for rental properties or long-term regular business, and how much you actually paid. CRA really only cares about the category. Now, we've talked a lot about recapture. Now it's time to dive into what recapture is all about, so then you can get a better understanding and full appreciation of how these different classes would apply in your particular situation, so you can do your own calculation yourself. So recapture is the amount of CCA that you over deducted when you sell your vehicle for more than the remaining tax value. Here's the idea in plain language. You claim capital cost allowance or depreciation, the 30% or whatnot, every single year to reduce your taxable income every single year. The tax system automatically assumes that the vehicle goes down in value every single year. And in our examples, it's assuming that the vehicle is going to go down in value approximately 30% annually, because that's the rate being applied all across the 3 classes that we discussed before. If you later sell the vehicle for more than it's available in the tax pool, which is called undepreciated capital cost, remember, every year you're only allowed to take 30% of what hasn't been depreciated. So that amount that hasn't been depreciated is calculated based on the purchase price minus whatever capital cost allowance you've claimed over the years. That amount, if your sale price is higher than the undepreciated capital cost, essentially the undepreciated amounts left in the asset pool in that particular class, then there is recapture that could be applicable. And of course, we talked about multiple times, recapture, it's only applicable to class 54 and class 10, not class 10.1. It's important to also note that the recapture income is really based on the business use percentage, the year of sale. So if you have recapture of $20,000 and in the year of sale, the business use percentage of that vehicle is only 10%, then 10% of that recapture income would be taken into income. So that is a variable factor that in our example that we follow, we will not get into. But this is an important planning point. If you know that you are selling the vehicle and if you know that you have high recapture income, it may be worthwhile to limit the amount of business use in the year of sale. So now let's look at the whole situation in real life using real number. And today we're going to use an example of a $75,000 vehicle. Seems a little bit high, but let's just use $75,000 vehicle so that it can illustrate the point. With a $75,000 vehicle purchase, automatically you cannot place it in class 10. So Class 10 would have been excluded in this vehicle. Remember, the criteria to fit into Class 10 is that the purchase price has to be under $38,000. Automatically, if you purchase a vehicle for over $38,000, it prohibits you. The Income Tax Act basically does not allow you to place the vehicle to be claimed under Class 10. So there's only Class 10.1 available or Class 54 available. Now, assume this vehicle could be a gas car of $75,000 and a zero emission car of $75,000, the same value, same purchase price. We're going to look at how they compare in terms of the tax deductions available and also compare the net impact at the end, because one class has recapture income when you sell and the other class does not have recapture income at all. So let's look at the facts about the cars. Let's just assume $75,000 pre-tax purchase cost, and the cars are going to be sold 3 years after for $30,000. And every single year, 80% of the vehicle is used in the business. For easy math purpose, I'm using tax rate of 50%. Your tax rate could be 40%, could be 45%, could be 30%, but for the purpose of today's example calculation, it's going to be 50% tax rate, just for ease of calculation. Now, the CCA rate would be practically based on the class, so it will be vary depending on the class situation. So with that, let's look at the example. Okay, so on screen, you can see the numbers clearly between Class 54 and Class 10.1. We mentioned earlier that both vehicles were purchased at $75,000. If the vehicle meets a criteria to fall under Class 54, that vehicle generally is an EV or like zero emission vehicle. You are allowed to claim up to $61,000. And it's worthwhile to mention that in this particular example, we have assume that there is no GST and HST. The truth is that if there is a GST or HST implication, depending on how you claim that expenses, this amount could be higher. So I'm not going to get into GST and HST. It's a topic of another day. Let's just go with the assumption that there is no GST and HST. It has been dealt with outside of the calculation. So the maximum allowed is $61,000 to be claimed over the entire life of the vehicle. So if you hold it for 10 years, the maximum you can claim is $61,000. But what's different about this Class 54 is that if you acquire the vehicle in 2024 and 2025, you would be able to claim 1.5 times of the 30% that would otherwise be available to Class 54 traditionally. So you can claim 30% and then also 1.5 times of 30%, which work out to be 45% of the undepreciated cost in year one. So that worked out to be $27,450 as your tax deduction, subject to the business use percentage. So then left over is about $33,000. You take $61,000 minus the calculated depreciation available according to CRA, and ultimately $33,000 is undepreciated at the end of the year. Now, this amount is then used to calculate year two's number. And year two, the traditional 30% would be applicable for Class 54. So 30%, the amount that you would be able to claim is $10,000, being 30% of the undepreciated amount at the end of year one. So we have $23,000 left. And in our example, we're going to sell our vehicle in year 3. So when we sell the vehicle in year 3, there is no capital cost allowance allowed to be claimed. So ultimately, at the end of year 3 or just before the sale, the undepreciated capital cost amount is $23,000. Now, so if you look at all 3 years total, the capital cost allowance, meaning the tax deductions that you're eligible to claim maximum, is $37,515. But because in our assumption, we lay out that business use portion percentage is only 80%, so only 80% of the $37,000 would be tax deductible. So we multiply 80% by 37,000, which is the maximum, prorated for the business use, and this would be the actual tax deduction to offset against your taxable income throughout the year. Now, we also make the assumption of the tax rate of 50%. Essentially, with a Class 54 vehicle purchase of $75,000, in 3 years, assuming you sell the vehicle in third year, you would be able to get roughly $15,000 write-off throughout the years. Now, on the flip side, if you look at the vehicle, a regular vehicle, gas vehicle, or vehicles that do not meet the criteria to be classified as Class 54, non-zero emission vehicle, all these vehicles would fall under Class 10.1. So that's $75,000 instead of having $61,000 maximum capital cost allowance limit allowed, we are only looking at $38,000. That only $38,000 is used for tax deductible calculation. Now in year one, 30% would apply to the $38,000, but half year rule would also kick in. So that means half year rule of 50% would apply. So in first year, you would only be eligible to claim 15% of $38,000, which is equivalent to $5,700. First year. And immediately you can see the difference. $27,000 write-off expense deductible versus $5,700. That's a significant difference. Now, at the end of year one, class 10.1 is going to give you a $32,000 undepreciated amount, which is then used to calculate year two depreciation. And year two depreciation is about $9,690. Ultimately, at the end of year two, you would have undepreciated capital costs of $22,610. Now, in year three, the year of sale, because we're trying to compare apple to apple. So in 2028, in year three, after the purchase, you're going to sell this vehicle as well. And the year of sale, also half-year rule applies. So you can still claim 30% of $22,610, but the half-year rule applies. So therefore, you are only eligible to claim 15%. This amount, together with the CCA in year two and the CCA in year one, you would then be able to claim a total of $18,782. You can see a huge difference between the two. And ultimately, when you apply the business use percentage, which is then used to calculate the actual amount that's tax deductible, 80% of $18,000 is about $15,000. And so applied to the tax rate, you're getting $7,513 of tax savings from buying this vehicle. So on the surface, it looks like class 54 is way better. So meaning that based on this calculation, you should really buy an electric vehicle, zero emission vehicle that meets the definition of class 54 for bigger write-off. But we also know that if you were to sell the vehicle, class 54 has recapture and class 10.1 doesn't. So let's look into the detail of how that recapture calculation would affect the overall analysis from a tax perspective. Okay, now that we have covered the deduction side, we also need to look at the sales side. Because under class 54, ultimately when you sell the vehicle, you will need to take into account the recapture income that you need to potentially pay back the tax benefit on. So in our example, 3 years later, we're going to sell this particular vehicle that we've owned for 3 years, and we're going to sell it for $30,000. So the same car is going to be sold for $30,000, and we're going to analyze both scenarios, whether we are buying a qualified zero emission vehicle that meets a class 54 definition or a regular car that doesn't fit that definition and that falls into class 10.1. Now, assume the sold price is $30,000. We had calculated from the calculation above that we have a remaining undepreciated capital cost amount of $23,485, which is really calculated by taking the original maximum allowed, subtract all the capital cost allowance that's allowed as of right now. We have the undepreciated amount of $23,485 for year three before the sale of the vehicle. Now, let's say the vehicle is now sold for $30,000. Typically, when we calculate recapture, we take $30,000 and minus that $23,485, and then we come up with the recapture amount. But because CRA has restricted the amount of capital cost allowance that we are allowed to deduct, so they are also giving us credit on the amount that they don't allow us to deduct. So the calculation for proceeds for recapture calculation, instead of $30,000, it's going to be prorated based on our purchase price in relation to the maximum allowable deduction of $61,000. So the calculation is basically $30,000, the sale price, multiplied by the $61,000, which is the maximum limit imposed by CRA, divided by our purchase price of $75,000. So once I did all that calculation, the proceeds for the purpose of recapture calculation is prorated accordingly. And ultimately, I subtract the depreciated capital costs at the end of the year with a recapture at the end of $915,000. And this recapture is also known as income that the taxpayer would have to report on their tax return in year 3. Now remember, the taxpayer has taken about $30,000 business use capital cost allowance in the past, and that resulted in $15,000 of tax savings over the 3 years period. And now this taxpayer would have to pay back taxes 50% on the recapture. But first, similar to the tax deduction, we're applying the business use portion first. So in our example, it's 80%. So we take 80% of the recapture amount that we calculated, assuming that in the year of sale, the 80% of the vehicle is still used by the business for the purpose of generating income. So we are taking $732 as taxable income. With tax rate of 50%, this particular taxpayer would have to incur a $366 tax payable on the recapture income. Now, with that $366 payable, compared to the amount that we save from previous years throughout the year by claiming capital cost allowance of $15,000, we are looking at a net tax saving of $14,640 if the vehicle meets the definition of Class 54 as a zero emission vehicle that qualifies and we're purchasing it in 2025. Now, if the vehicle does not meet that criteria and it falls under Class 10.1, that $30,000 sale price would have nothing to do with any calculation because Class 10.1 does not have a recapture rule. So there is no recapture on the sale of the vehicle. And from there, if you just look at the tax savings simply by looking at the tax deduction calculation throughout the year, the 15% in year 1, 30% year 2, 15% in year 3, and then it's sold for $30,000, that would result in a $7,513 of tax savings. And that get carry over because there is no taxable income, no recapture. And ultimately, if you compare overall tax saving between Class 54 and Class 10.1, you see that there is almost double of tax saving if you buy zero emission vehicle under Class 54 that meets that criteria. So obviously, it is a lot better to purchase a Class 54 vehicle, so meaning a zero emission vehicle, Tesla, whatever vehicle that you're thinking of buying, that's giving you the tax benefit in Class 54 rather than buying a vehicle that doesn't meet the requirement. Now, but what if you say, well, we didn't sell it for $30,000, we sold it for $40,000, because remember that sold price matters in our calculation. Remember Class 10.1, we don't have any recapture income. But if we sell more, we sell for a higher amount in 3 years, maybe the benefit would not be as substantial. So if I were to update my sold price to $40,000 and the formula follows along, basically I'm going to have an overall tax saving of $11,000, whereas the Class 10.1, I would have an overall tax saving of $7,500. We're still way more ahead with buying a zero emission vehicle compared to buying a traditional vehicle that doesn't meet the zero emission criteria for Class 54. Now, let's say if you are able to hold the value of the vehicle and it's sold for $50,000 in 3 years. Even if you can sell the vehicle for $50,000 in 3 years, you're still slightly more ahead with Class 54 vehicles, the zero emission vehicle and electric vehicle, than a traditional vehicle that doesn't meet the criteria. So, all in all, in 2025, if you were to purchase a vehicle of the same value, and that is over $61,000, between the choice of having a zero emission vehicle or a traditional vehicle, it looks like you will have better tax saving by purchasing an electric vehicle. Now, you may say, hey, then what about the situation where I want to wait until next year to purchase a vehicle? You mentioned earlier that the tax deduction is different. Well, absolutely. If you wait until next year to purchase a vehicle, the calculation is different. Now let's look on screen that how it's different. Now, if you look on screen right now, you can see that what's different is the first year calculation of the taxable amount that you see in front of you. So if you purchase it in 2025, you still have about a month and a half to go. If you purchase the vehicle in 2025, you would be able to deduct the $27,450. The maximum is capped at $61,000, but the first year you're allowed to claim 1.5 times of 30%, so you're allowed to claim 45% of the maximum limit allowed, so that's equivalent to $27,450. If you wait for a few months and purchase a vehicle in 2026 or 2027, you are now down to 25% calculation. 25% is allowed for year 1 calculation, but no half-year rule. It is still better than class 10.1 calculation. So after claiming the larger amount in year 1, you have less capital costs available to calculate the capital cost allowance for year 2 under the 2025 acquisition scenario. If you were to purchase in 2026, because you claim less depreciation in year 1, you have more available to claim capital cost allowance in year 2. So your year 2 depreciation expense is higher, your tax deduction would be higher. But all in all, if you were to purchase a vehicle in 2026, and assuming that you're selling the vehicle in year 3, you would only be able to save about $11,590 of tax, whereas if you were to purchase it in year 2025, you would be able to save $15,000. Now, obviously, the delta between these two, about $3,500, it would be diminishing the longer you hold this particular vehicle. So it would not as much a difference the longer that you hold a vehicle, because you're going to grind down the amount of capital cost allowance that you'll be claiming over the years. So you may wonder, is the electric vehicle still worth it for tax purposes? I mean, from a pure tax perspective, particularly if you are purchasing the vehicle in 2025, EVs class 54, including Teslas, will still allow you to claim higher capital cost allowance in the first couple of years of purchase, because there is a limit difference between $61,000 and $38,000 that's imposed by CRA. EVs can still give larger deduction upfront, particularly in 2025 to still all the way to 2027, to be honest. You're still getting way bigger deduction with the EV purchase. Other vehicles will have no recapture though. So other vehicles that do not meet the EV requirement will have no recapture income. So ultimately, what's better? It is hard to tell. The scenario that I've given you assume that you're going to sell the vehicle within 2-3 years, but the reality is that a lot of us keep the vehicle for a longer period of time, and the difference between the two may or may not be substantial depending on the make of the vehicles as well. Ultimately, tax is only one side of the equation. The reality is that we all have our cash flow preference, we all like to drive certain type of cars, and sometimes we live in a condition that would only allow us to drive gas car per se. My uncle is an HVAC technician and he often has to haul around different things, and it's not practical for him to drive an electric vehicle because the hauling part would take away and eat up all the electricity, all the power available within an EV. So it's not practical for him to drive an EV altogether, despite the fact that he probably would get better right off with an electric vehicle. Now, choose an EV if you have easy access to charge at home or at work and prefer lower long-term maintenance, like the driving experience and tech, and are okay with the recapture on sale, although there is planning around that as well based on the business use percentage the year of sale, and want bigger and higher depreciation as soon as possible. Now, I would also recommend you to choose a gas car if you prefer predictability and no recapture ultimately on the sale of the car, drive long distances all the time with very few charging stations in between, may prefer a lower upfront purchase price. You may also consider a regular car if you plan to lease a car and don't plan to own it long term. Now that we've covered everything, thank you so much for watching. If you have questions and if you find this video useful, make sure you share that with people who understand this or want a deeper dive on this particular topic, and also give us a thumbs up if you find our video useful. I know this is a confusing topic because I also need to do the research and confirming all the facts and calculations before doing the presentation here. So if you have any other questions and you want a particular question to be answered, make sure that you drop us a comment below. Or if you're confused and your accountant can help you with the answer, feel free to give us a call. Until next time.